Another disclaimer, very important. 2022, didn't you love it? As Kevin's already suggested, it was a bit of a test of a year. Talk of recession, worries over climate change, rising interest rates, Sam Bankman-Fried in the bottom hand corner there, trade tensions. It was a bit of a tricky year. And as a result, again, as Kevin's already suggested, unless you were basically heavily exposed to commodities from an investment point of view, you had the sort of year that, as Raymond Chandler would have said, would have made a bishop kick a hole in the stained glass window. It was extremely tough going. Equities down, bonds down. In fact, Bitcoin, I did have it on the end of this chart and it fell off. It went down by that much. It was down by about 70%. And the only thing that did you any good were indeed oil, gas, commodities more generally, and even gold actually didn't completely cover itself in glory, but it more or less held its own ground. And in terms of individual stock markets, if you're exposed to India and Brazil, well done you, that was absolutely tremendous. If you're exposed to the UK, you actually came out of it pretty well, and we'll come back to that. I mean, one of my jobs is I do a lot of media work, I do talk to the press, and I can't tell you how down the people have been on the UK market for the last 2, 3, 4, 5, 6 years. The only questions I ever get about it are, isn't it rubbish, there's no IPOs and there's no floats? And when something receives that amount of abuse, it's intrinsically quite interesting, and lo and behold, it actually outperformed last year. The areas, of course, that were the most hottest and popular coming into the year, the tech stocks, well, there we go. Nasdaq didn't reward that sort of support and had an absolute shocker. Now, we should be talking about drumming pigs. This is the first frog I think you'll see this evening. So the pig count's low, the frog count is high. And it was a difficult year last year, but I do want to, without getting carried away, I do want to sort of start things off on a very positive note. So Morgan Housel, American economist and thinker, some intriguing quotes from him. One, the pessimists are probably wrong and extrapolate a bad decade into infinity. And we do that because our most recent feelings are our most intense and the ones that we logically perhaps expect to continue or instinctively expect to continue. This picture is, in inflation-adjusted terms, the richest person who ever lived. John D. Rockefeller, he owned Standard Oil. In fact, he was that wealthy and it was that powerful it had to be broken up by the American regulators. When John D. Rockefeller was in his pomp, in the fullness of health, there was no electric light. There was no penicillin, there were no sunglasses, there were no air conditioning. Amazon, forget it. He had his own private train, but it took him 7 days to get from New York to San Francisco in it. Aeroplanes? No. His life all right, he lived to a long life, but the average life expectancy of the American male when he was around was about 40-odd years. So in some ways, fundamentally, we are all richer than the richest person who ever lived. Now, I'm not saying that the world is perfect, that food, medicine and water are equally divided, because they're not. Opportunity is not necessarily available to all. But in some things that we completely take for granted, we're richer than John D. So it's something that is worth bearing in mind when you turn on the news in the morning and think, that's one positive. Another, change is the only constant. And we've come through it with enormous success. Betting against human ingenuity for the last 2, 3, 4, 5,000 years has not been a good bet to take. And it, in fact, is often in the crucible of a crisis or of troubled times that some of the best solutions come out to solve those problems. This is from Ben Hunt of Epsilon Theory. He writes a fantastic blog. That is, of course, a very old basic telegraph. So I know that we all think that investing now during a time of internet and social media and multiple sources of information coming at you constantly, it was probably even more frightening to be encountering the telegraph cable and the telephone for the first time. A big change from Jesse Livermore sitting reading the tape coming across to having been able to look at live feeds all the time. So again, change is entirely normal, and if it can be embraced, it can bring fantastic things. Similar principle again from the master investor, Mr. Buffett. In the 20th century, the US suffered 2 world wars, traumatic military conflicts, the Depression, a flu pandemic, a disgraced American presidency, and still the Dow Jones index went from 66 to 11,500 over a period of 100 years. And Ben Graham, Buffett's mentor no less, the investor who permits himself to be stampeded or unduly worried by unjustified market declines, is perversely transforming their basic advantage of being able to sit still, do nothing, stick to their guns and ignore the ticker tape into a disadvantage. That person would be better off if their stocks had no quote at all. They'll be spared the mental anguish caused to them by other people's mistakes of judgment. So again, over the long term, good things can happen. and in fact, do happen. So yes, there are tricky times, and I have absolutely no doubt this is one of them, but it doesn't mean it's going to last forever. I would suggest quite the opposite. If history is any guide, and betting against that history is a bet I am not prepared to take. And I say that as a signed-up member of the awkward squad, because I am from Yorkshire and therefore naturally contrarian. So how can you, even during these difficult times, knowing that things will get better and that out of this crucible of difficulty there will be something that comes, how can you get through it? You have a process. You have a discipline. You know thyself, and you stick to it. And in some ways, the simplest ways of doing this is having a little checklist. Because it then stops you getting caught up in those bad headlines, those testing times, thinking, oh, I need to do this, because that share price has moved against me. No, if your process is thorough and rigorous enough, it will withstand anything that can be thrown at you. And when I started as a very junior fund manager in 1991, albeit not a very good one, and then a very junior analyst in 1993, I actually built my own little checklists of the things that I was looking for in stocks that made, I thought, for me, made them good or bad investments or good or bad ideas. So this is my checklist. I use it for my column in the newspaper every Tuesday. AJ Bell doesn't give advice, but when I'm looking at specific companies for press comments, these are some of the things that I look for. So I look for a scalable model, something that can be, leveraged up pretty quickly. Software is obviously the ultimate answer. You just develop it once, pop it in the post, the CD-ROM or whatever it is, and away you go. Ultimately, the thing I'm looking for above all else is a competitive advantage, because that's what you're buying. A company that can charge the prices it wants rather than the prices that its customers are prepared to pay really is in a fantastic position. Or a company that can provide, that solves a solution and provides value to the customer is really potentially going places. I don't care if the share price moves up or down 20% if I know a particular company is brilliant at what it does and its customers value what it can do for them. They may buy less over time during the bottom of the cycle, but they'll buy more over time when the cycle picks up. Better, not cheaper. Yes, companies can cut costs and sack people, but in the end, that's a short-term fix and it's low-quality earnings. And I love pricing power, again, that ability to charge what people want. I have a devil of a time getting Sky to cut my bill. It's really pretty easy for me to go out and buy cheaper bars of cheaper products, cheaper beans, or go to a cheaper supermarket. I love cash conversion. I love free cash flow yields because they mean that, again, they provide things like dividends, and I like strong balance sheets. I'm not anti-debt, but there is a certain amount of debt that is suitable for certain businesses. Utilities can withstand lots of it. Airlines, not so much. Those businesses with dependable revenue streams, yes. Unpredictable cyclical ones, no. Good dividend cover is helpful, and yes, strong management matters a lot. They don't often have grey hair or no hair, but certainly skin in the game and a strong record is a big advantage. We'll come back to management shortly. Okay, what do I try and avoid if I possibly can? Dominant CEOs. Who are they working for? Themselves or you, the shareholders? There are lots of robber barons out there, of that there is absolutely no doubt. Any press release that tells me the company has made a transformative acquisition, straight in the bin. Transformative means, God, we really, really wanted it. We know we've overpaid for it, but it will transform our business. It normally does, just in a very bad way, in the way that they don't expect. Focus on growth. Growth of what? Any fool can grow a business by buying lots of things. Ask Fred Goodwin. Didn't create much value over the long run, though, did it? Earnings per share triggers for bonuses, not good, too easy to fiddle. Frequent exceptionals in the accounts. Oxford English Dictionary. Exceptional means it doesn't happen every year. So companies that constantly fiddle with their accounts and mark their own homework and tell you about how wonderful their adjusted EBITDA numbers are, no. I had a journalist ring me up the other day saying, isn't it great that Ocado's making money? I said, yeah, it is if you exclude 8 lines of its P&L. No. Weak cash flow isn't good. Again, debt is fine, but a mixture of high operational and financial gearing is tricky. Operational gearing means 1% change in sales provides a much bigger percentage change in earnings. That's a good thing in the cycle on the way up, very difficult on the way down if you've got lots of debt. Weak interest cover, weak dividend cover, and again, failure to... Ultimately, value is not a share price going up, it's your return on invested capital covering your cost of capital. Maybe that's one for a column in the newspaper, but a rising share price is not creating shareholder value. And any company CEO who tells me it's my mission to create shareholder value, well, how are you going to do that if you've got no happy customers? So you've got to talk to Bob about your customers first and your proposition before you talk to me about your share price. Manage the assets, share price will take care of itself. a rogues gallery. Azil Nadir, Robert Maxwell, Dennis Kozlowski of Tyco, who bought a $30,000 shower curtain with shareholders' money. Ken Lay of ExxonMobil, bottom left. Fred Goodwin, mentioned him already. And then Dennis Muhlenberg of Boeing on the bottom right there, the man whose company decided to sort of short-circuit a software upgrade, short-circuit a major redesign of its planes, stick some software on it, and end up killing some of its customers, which I would view as about the worst experience you can offer anybody. How do you spot bad bosses, the people who can genuinely do harm to your business? This actually was given to me by a Boston-based hedge fund manager. He's updated it a bit, but he specialized in short selling. His office was wallpapered with share certificates of companies whose shares have gone to zero. So George is a professional short seller, and this is his list. And these are things that he doesn't like to see, particularly now. He's active again, been dormant for 10 years. Now he's busy again, so I wonder what he's thinking about the markets. These are some of the things that he doesn't like to see, but it's particularly, again, allegedly busy executives who've got far too much time on their hands to pick fights with people on Twitter is probably right at the top of his list. And it's something that's worth bearing in mind. We mentioned earlier on that the UK surprised a lot of people last year by doing quite well. And this is probably my favourite saying. You can have cheap stocks and good news, just not both at the same time. So pessimism in some ways is the friend of the investor, because again, if you listen to Ben Graham and people have panicked, they may have sold assets that actually are now potentially really, really interestingly valued. And price or value is the ultimate arbiter of investment return. So yes, I can talk about price. And again, I love talking to the press. It's great fun. You're constantly challenged. But because they've got lots of space to fill and they're in a desperate hurry, they're obsessed with sentiment. And I said to them, well, I don't know, because most of the trading is done by a computer now, and I don't talk to them. I don't talk to algorithm funds, and they're the ones who are doing most of the short-term trading. But what can affect price? Yes, you can have momentum in earnings forecasts. You can have people talking about interest rates and markets and style and fashion and charts and Andrews pitchforks and fear and greed. And yes, they will move the share price, but they'll make absolutely no difference to the fundamentals of the business. Profit, cash flow, the growth it can generate, the risk it takes to generate that, the quality of the earnings and how predictable they are, how credible the strategies and the management are, and ultimately, does the share price going up and down affect the company's competitive position? No. The company's competitive position will ultimately decide where the share price goes, and that's what you really need to spend your time working out is, why do people go to this company and buy their product or their service rather than going someplace else? And if the answer is they provide fantastic value, it's really hard to get someplace else, you're potentially onto a winner. In the end, Buffett called his business Berkshire Hathaway because it was named after one of the worst investments he ever made, a suit lining business. Now, I wear Paul Smith suits just because they fit, and I'm lucky enough to be able to buy them. Okay? But I buy a Paul Smith suit, I don't really care where the lining comes from. Same thing. Why do I buy it? Because it works for me, and it's within my price bracket, and I like them. The lining, I just don't care. I buy a car, I want a big one because I've got kids who play hockey and cricket. I don't care where the steel comes from. I don't care whether it's Bethlehem, US Steel, ThyssenKrupp, or whatever. So it's again, why do I go for that product? Because that product suits me and I can't get it necessarily anywhere else. That's what you're looking for is competitive position. And again, we mentioned pessimism. This is a feel-good meeting. Bull markets are born on pessimism because that's when things are at their cheapest. That's when people have given up. The wet towels have slopped into the ring. They grow on skepticism, they mature on optimism, and they die on euphoria. I got into awful trouble on Twitter during the meme stock frenzy in 2021 when I was asked to talk about GameStop and AMC Entertainment. And I sat behind me on my bookshelf a copy of Charles P. Kindleberger's Manias, Panics and Crashes, so the cover was staring right out at everybody. And I was asked, how high could these things go? And I said, I've absolutely no idea. I didn't think they'd get here in the first place. But once it starts, it can go on for a very long time. But all I know is when the musical chairs stop, somebody's going to get hurt. That was euphoria. And if you bought the top tick, you're probably feeling pretty sorry for yourself in GameStop right now, and AMC and all those other things. So this is a game I play with myself, and just thinking, what questions are people asking me now? Again, because I'm a naturally contrarian, awkward person, I'm always interested in what people aren't asking me about, not what they are. So I just do this every quarter, probably. What is nobody asking me about right now? Well, they've written off commercial property as a dead loss. They're still telling me that oil and fossil fuel people are dirty, nasty, filthy people. And they're still telling me that emerging market equities and bonds are in for a pretty tough time because the dollar's really strong, they've got too much debt, and the economy's about to drop in a big hole. They're sceptical on UK equities still. Stupid discount after the political situation. Some people don't like it because of Brexit. Some people don't like it because it's packed with oils, miners, banks and insurers, the unforecastable, the indigestible, the interminably slow. Nobody's asked me about gold for years. Kev will be very pleased about that because he absolutely detests it. Government bonds, yeah, it's turning a little bit. People are generally worried about inflation. Residential property, people are getting a little bit upset. Optimism. European equities, people are a bit, I've got a few questions about those. US equities always. Growth stocks now, the Marnham stocks have started to rally. And again, the Tesla, lots of questions on that now. It started to rally. And GameStop and AMC, now they're rallying. They've almost, in fact, moved back into euphoria. And your reward for, of course, is getting euphoric by buying meme stocks is Bed Bath & Beyond saying, oh, fantastic, have as many shares as you want. And the share price promptly goes down the next day. So be very, very careful with those because a lot of them have got very weak balance sheets and they'll start tapping you for cash as soon as they can. And cryptocurrencies, lots of optimism there. Even after the alleged fraud at FTX or whatever's gone wrong, lots of enthusiasm there. So again, perhaps being the awkward squad, I'd be a little bit wary. So, conclusions. None of us know what's coming next. We'll do our best to help you. But we're all trying to work out whether it's inflation, deflation, or stagflation next. The big rally that we've seen this year is telling us inflation will gently recede, interest rates will start to come down, there will be a shallow recession. It's a lovely hat trick if achievable, right up there to match Jeff Hurst's, if you're English anyway at least. But it's possibly asking a little bit much after the biggest round of fiscal and monetary stimulus that we've ever seen. And the question that we all really have to ask ourselves, and I don't like saying it's different this time, but we have had a 40-year period of cheap energy, cheap labour, cheap capital, cheap money. If that is going to change, then what's worked really well for the last 40 years might not work quite so well for the next 40. It doesn't mean equity markets and bond markets are doomed. It just means that certain things might take the lead different from what we've been used to taking the lead. Might not be long duration assets. Might not be tech, it might be something else. And then if we do get a change of mood music, again, what could it be? I don't know. But I think one thing that intrigues me is this chart. And I could do it for lots of countries. This is total US debt securities and loans. It's been growing very quickly since Richard Nixon took America off the gold standard in 1971 to pay for guns, butter, welfare programs, and war in Vietnam. And the rate of growth has generally accelerated. That little round ring there, that's the global financial crisis. A massive heart attack for the global economy, and look how much credit shrank by. You really think that line there is going to start pointing down anytime soon? Or at least without causing an awful lot of pain if it does? So how easy is it going to be for central banks to really jack up interest rates and conquer inflation? Because every percentage point on those interest rates, as Rishi Sunak said, is £25 billion on the government's interest bill over time. So yes, central banks, I think, will be trying to conquer inflation. Their room for doing so may be somewhat curtailed. We shall see. But if they do have to start cutting interest rates and say that 4 is the new 2, for example, for inflation, maybe the bond vigilantes will rebel or the equity punters won't turn up to the party this time. But equally, there may just be some people thinking maybe there is a different store of value out there. If they are just going to start treating money like it's confetti to keep on funding all this debt, commodities did begin to outperform last year. Now, they've lost a bit of ground this year, but that top left chart shows the S&P 500 relative to the Bloomberg Commodity Index. Line goes down, equities outperform. Line goes up, commodities outperform. So disinflation, equities 1, commodities 0. Loss of central bank control, lots of money printing, great financial crisis. Commodities do well. Central banks are back in charge. Don't worry, it's all fine. They've got our backs. And now markets are wondering, we're not quite so sure, so we'll see. And just to upset Kev right at the end, this is gold against the S&P 500. Buffett, of course, will describe it as useless, a pet rock, something if you tripped on it, it would do you absolutely no good at all because it doesn't generate any cash. But it has been money since time immemorial. It has had its moments in the past when, again, there's been loss of faith in policy, dare one say for once, for a better turn of phrase. And right now, gold relative to equities, flat on its back, gold miners the same. If they do go back to printing to fund this colossal debt, as there has to be a small risk, if history is any guide, they will see us through, there will be a solution, but it may mean that just different things take the lead. We'll see. Thank you very much for your time, everybody. I really appreciate it.